$40 trillion is going up in flames right now. And China is lighting the match. From oil deals to gold trades, 150 countries are quietly turning their backs on the US dollar. The weapon? A digital currency built to replace America's financial dominance. One by one, global trade routes are rerouting away from Washington. This isn't just economic strategy, it's a silent war. And if you think it won't touch your savings account, think again. This is how China is winning, without firing a single shot. For decades, the US dollar wasn't just a currency, it was a weapon. Washington could sanction, isolate, or cripple any country with a single financial decision. But now, nations like China, Russia, and even Brazil are building their escape routes, trading oil, gas, and weapons without touching the dollar. It's not theory. In 2023, over 40% of China's foreign trade was settled in Yuan. And that's just the beginning. This isn't a prediction. It's happening now. Saudi Arabia is selling oil to China in Yuan. Russia's central bank holds more Yuan than euros. Argentina is paying off IMF debt using Chinese currency. Bit by bit, global finance is shifting. And America's grip on the system, it's slipping faster than anyone expected. The US dollar dominates because global trade runs on it. Energy, shipping, raw materials, all priced in dollars. That gives America leverage. Control the dollar, control the system. But now, China is building an entirely new financial architecture outside of Washington's reach. A system where loans, settlements, and reserves are all in yuan, and it's already operational. The ripple effects are already hitting American influence, and faster than most experts predicted. Allies like India and Saudi Arabia are signing massive defense and energy deals without US approval, and they're financing them outside the dollar. Meanwhile, central banks across the globe are dumping US treasuries at record pace. Dollar reserves are shrinking, and new payment systems are expanding across Asia, Latin America, and even parts of Europe. Washington is watching its financial power dissolve, not over decades, but in real time. Here's how it works and why it's spreading so fast. China's state-owned banks issue long-term loans in yuan to developing nations. These countries use that money to hire Chinese companies, import Chinese goods, and build Chinese-designed infrastructure. As trade flows back, those same yuan are recycled into ports, energy plants, and strategic assets controlled by China. It's a self-contained loop. No dollars, no Western banks, and no approval from Washington. Now let's step back and examine what's actually happening beyond the headlines. Here's the reality. China's cross-border interbank payment system, CIEPS, isn't just a concept. It's operational and growing fast. In 2024 alone, CIEPS processed $24.45 trillion in payments. That's a 43% increase from the previous year. The system now connects over 1,130 financial institutions across 109 countries. But here's what the numbers don't tell you. While SWIFT processes about 42 million messages daily, CIPS handled 8.2 million transactions in 2024. That's still a fraction, but it's tripled since 2020. As the IMF notes in their 2024 analysis, alternative payment systems represent diversification, not replacement of existing infrastructure. So if it's not replacement, what exactly is happening to dollar dominance? The International Monetary Fund tracks exactly how much foreign currency central banks hold. And the trend is clear, but not catastrophic. Dollar reserves dropped from 65.36% in 2016 to 57.80% in late 2024. That's significant, but it's an 8-point decline over 8 years, not a collapse. But there's something else happening that's more important than the percentage. Central banks bought 1,037 tons of gold in 2024, the second highest annual total in over 50 years. Countries like China, India, and Turkey are diversifying away from all paper currencies. This isn't just about the dollar, it's about reducing dependence on any single currency system. According to the Atlantic Council's 2024 analysis, if gold purchases are included, the dollar's effective share of reserves is smaller than headline numbers suggest. So who's actually making this shift, and how fast? The shift isn't happening everywhere at once. It's concentrated in specific regions and relationships. China and Russia pledged to reach $250 billion in bilateral trade by 2024, with much of it settled in yuan and rubles, not dollars. But Russia isn't the only country exploring alternatives. India and UAE launched bilateral trade in rupees and dirhams. Brazil and China expanded their currency swap agreements. Argentina used Yuan to pay IMF obligations. Yet these bilateral deals still represent a small fraction of global trade. The dollar remains the currency for about 88% of foreign exchange transactions. The petroleum market tells the story best. While China does buy some oil from Russia and Iran in yuan, roughly 80% of global oil transactions still use dollars. As the Federal Reserve noted in their 2023 analysis, the dollar's role in global trade financing remains robust despite regional diversification. So, what does this gradual shift actually mean for the United States? Every shift away from dollars has real implications for American economic power, but the timeline matters. When countries hold fewer dollars, they buy fewer U.S. Treasury bonds. That could mean higher borrowing costs for the government, and eventually, higher interest rates for everyone. But there's a more immediate concern that few people understand. The dollar's power comes from its necessity. When countries can trade without it, U.S. sanctions become less effective. Iran's oil exports to China increased despite sanctions, partly because transactions avoided the dollar-dominated banking system. However, the dollar still benefits from what economists call network effects. The more people use it, the more valuable it becomes. And the U.S. still has the world's largest, most liquid financial markets. The IMF's 2024 report notes, dollar dominance reflects deep structural advantages that change slowly over decades, not years. So if change is gradual, what's China's actual strategy? China isn't trying to replace the dollar overnight. Their strategy is more sophisticated and more patient. Through the Belt and Road Initiative, China lends yuan to developing countries. Those countries use yuan to buy Chinese goods, hire Chinese companies, and build Chinese-designed infrastructure. It's a self-reinforcing loop that doesn't require global dollar replacement. China is creating regional zones where yuan is the natural choice. Southeast Asia, parts of Africa, and Central Asia. But even China faces challenges. The yuan represents only about 7% of global payments, compared to the dollar's 47%. As foreign policy analysts note, China seeks multipolar finance, not yuan dominance. They want options, not replacement. So where does this leave us? The $40 trillion question isn't whether the dollar will disappear. It won't. It's whether America will adapt to a world where financial power is more distributed. Currency transitions happen in decades, not years. The British pound remained important for 50 years after Britain's peak. The dollar's dominance won't vanish, but it will evolve. The real story isn't Chinese currency replacing American currency. It's the world building multiple financial systems that can operate independently. For you, this means understanding that the next 20 years will look different from the last 20. Not catastrophically different, but different enough to matter. And that brings us to the most important question. In this new multipolar financial world, who actually benefits? And how do you position yourself for what's coming next? Because while the dollar's dominance is evolving, the opportunities in this changing world are just beginning. If you found this useful, your comment, like, or subscription helps us reach more viewers and keep the conversation going. We'd really appreciate your support.